Sounded like they used to mean something in this town. They used to pull the hog out and they used to eat it. I'll give you a winter prediction. It's gonna be cold, it's gonna be gray, and it's gonna last you for the rest of your life.
Well, hello there, my friends. Rafi here from the End Game Investor with this week's Silver Report for Arcadia Economics. And the silver market might be a little bit boring in terms of price action right now, but as always, there is a lot going on underneath the surface. We're going to get into all of it. Well, not all of it, all that I found and I'm covering. I find interesting this week. First, we're going to talk about why I'm not worried about gold or silver confiscation by the government. And after I show you these charts and this data, you won't be either, hopefully, but you might be a little bit more worried about buying gold and silver ETFs for the purposes of living out the end game. We're going to talk about why silver is still money from a graphical perspective, looking at silver compared to other commodities and what happens in a time of severe deflation. Deflation, inflation, it doesn't make a difference because gold and silver are money, and you'll see why in the chart that I will show you. There's evidence from the Fed's Beige Book that we are at the inflection point between when higher interest rates cause consumer prices to fall and when persistently higher interest rates cause consumer prices to rise. I'll show you this logic. Will hopefully clarify why eventually higher interest rates cause consumer prices to rise even faster, which is what eventually spins the engine out of the Fed's control, and why the current dollar rally, having broken through the 50-week moving average for the first time since 2021, could be the final dollar rally before the end game. Is it necessarily? No, but there is a reason why this one might be it. This week's Silver Report is brought to you by Fortuna Silver Mines, symbol FSM, and there is some fun news this week. I'm going to put on my geologist hat for a second. Fortuna Silver Mines on September 7th is pleased to announce that the processing plant performance test was successfully completed at its Séguéla mine in Côte d'Ivoire in August. The processing plant achieved designated performance. Basically, what this means is that the final stages of getting the mine at full capacity are completed. We have all these interesting numbers that I don't quite understand as I am not a geologist, but this I got because I know what a micron is. Mill grind size is less than 75 micron. Well, that's not a lot of microns. Well, I can't read. And here, I understand this one. Gold recoveries at between 85 to 95%. Jorge Ganoza, I also understand this line. President and CEO commented the completion of the performance test closes the successful construction and commissioning phase of the Séguéla mine. Since the first gold pour, Séguéla has produced a total of 21,716 ounces of gold. And so while the prices of silver and gold continue to frustrate the gold and silver bugs, the companies that mine it out of the ground, or the ones that I like, are continuing to be good companies, which includes Fortuna Silver Mines. And of course, this is not investment advice because I don't give investment advice. Advice is illegal because, freedom of speech. Anyway, on to this week's Silver Report. First thing I want to talk about today is gold confiscation and then silver confiscation. I got a few questions on the Endgame Investor from subscribers this week, and I wanted to share my answers to those questions. Am I worried about gold confiscation? People were sending me articles. What happened in the 1930s? Is it going to happen again? It's always possible. I just think it's very unlikely for this reason. And here we can actually thank ETFs because in this case, they're pretty useful. So why I'm not worried about gold confiscation, if we look at these charts over here, and the one on the left, is the total gold ounces held in all paper gold ETFs in the world. And we see that it is 123,678,000, which is 123.678 million ounces of gold held across all paper gold funds since 2000 here. It has gone down since 2020, but not that much down. The gold value held in dollars, that's irrelevant. That's just part of the graphic that I cut and paste, but who cares about the dollar value right now? It's not the point. So we have, if we convert this to tons, 123.6 million ounces, that's 3,847 tons of gold in ETFs, about half of the gold in Fort Knox. Now, what is easier for the government? To confiscate the ETFs, which they can do in a second with the snap of fingers or an executive order or whatever they want to do. They can just do it because, there's no liberty in the world and the government can pretty much do whatever it wants now. So yeah, it could just take the gold out of all the ETFs and say that it's theirs now, just like Roosevelt did when he said all the gold in everybody's vaults or everybody's safes or everybody's like desk drawers or closets, it's mine now. That's what he said. So why can't they do it with ETFs? But you see, in the 1930s, there were no ETFs. There were no centralized or heavily centralized. I mean, they existed in banks, but there were no ETFs of gold where these huge stockpiles of gold existed that the Roosevelt government could just take. So they had to, ask nicely through an executive order and just rely on voluntary contributions, under threat of whatever it was. So it's a much easier task to just take ownership of this gold, and they would have increased their gold supply by about 50%. All right. And here's why I'm not worried about silver confiscation either. Now, if we look at the amount of silver in all silver ETFs, here's gold down here in the gold. I do make jokes about myself that I'm colorblind, but I can tell that the gold is gold and the silver is silver because, the word matches the color here. So it makes it very easy for me. We see here that the total amount of silver in the vaults in ETFs is, what is it? It's 1,324 million, 1.324.65. There's no 2 points. 1.32465 billion ounces of silver. Now, if you compare this to the ounces of gold, which is 123.68 million, the ratio is about 11 to 1. The ratio is about 11 to 1. So let's just estimate and let's just bring it up to 15 to 1. I know it's not exact numbers, but the point is, the only thing that would motivate the government to even think about actually confiscating gold and silver would be a monetary crisis. And in a monetary crisis, as I've repeatedly said, the gold to silver ratio will go to 15 to 1. And so if it theoretically confiscates all of the silver ETFs also, it will have doubled its gold value supply, basically, because the supply of silver here is 11 to 1. So let's say 15 to 1. So this is the same value as this in a monetary crisis, which would be 15 to 1. And they could double the amount of gold in Fort Knox or under the government's balance sheet, whatever, to actually go to people's safes and confiscate them and knock on their doors when there's actually a hyperinflationary crisis is not going to be easy. It requires resources. This is much easier to do, and this is what they will do first. So be aware of that when you buy ETFs. Now, here's a chart of silver against the CRB index. And there's a point I want to make on this, on the right side of the chart. Okay, so first of all, you see this is silver relative to other commodities. And since 1990, since before then, the value of silver relative to other commodities has trended a lot higher. Right? It's obviously very volatile over here. It was less volatile over here. As the monetary system crumbles, things get more volatile, both up and down. We all know this. But this spike, I wanted to put it in context. We remember what was happening here. It was March, April 2020, and there were lockdowns and all this other lovely, lovely, beautiful things that were going on. And the value of silver relative to other commodities spiked to an all-time record high. We can see here that the 2011 high in terms of other commodities was about half, about a little bit more than half the value. So this is almost double this peak. Now, what was really happening here? It was extremely deflationary in that time period. Debt was collapsing because of the lockdowns. The economy was falling apart. The value of the dollar was rising because there was a liquidity crunch. The point is that this was extremely deflationary until they started printing the money, right, to inflate back out. And so people ask, like, what's going to happen to silver in a deflationary environment? Well, we already see what happens here. Maybe the dollar value does go down. It does. Oh, it certainly does. But the purchasing power, even as the dollar value plummets, is rising because all other commodities are plummeting even faster, right? And silver plummets the least, or not the least, the second least. The real least is gold, right? That's the most stable. But we see here that even in a hyper deflationary environment, silver will do relatively well in purchasing power, regardless of its dollar price. Now, this is a paragraph that I've cut into 4 sentences from the Fed's beige book, because really beige is, it's the most inspiring color. It It inspires emotional ecstasy, beige, whatever. It's a book. So why higher interest rates eventually cause consumer prices to rise. That's my title. The Fed didn't say that, right? They don't admit that. So here is the paragraph from the beige book. It says, most districts reported price growth slowed overall, decelerating faster in manufacturing and consumer goods sectors. So price growth slowed. Okay. However, contacts in several districts highlighted sharp increases in property insurance costs during the past few months. Okay. Contacts in several districts indicated input price growth slowed less than selling prices as businesses struggled to pass along cost pressures. As a result, profit margins reportedly fell in several districts. The point of this is to say that when you start to raise interest rates, the first thing that happens is that the debtors, or really the people that have to borrow money in order to consume, the people that are consuming based on loans, they can no longer borrow. So they stop borrowing and then they consume less because they can't consume as much because they were borrowing to consume. So demand falls initially. When demand falls, prices rise less or even fall. And that is why in the initial stages of an interest rate hike cycle, consumer prices rise less fast or could even fall. But eventually, the higher interest rates affect the producers and not just the people who live on consumer loans. And that is what we're starting to see now. The higher interest rates are making people more picky about prices, and companies are less able to pass through their costs to consumers. And so they have to eat it. And then eventually the weakest companies can no longer take it and they have to go out of business. And other companies where their profit margins are being crimped, they have to lower their production in order to bring their profit margins back up. So supply goes down. On the margin, those companies that are highly indebted that can't handle the high interest, they go bankrupt. And the companies that want to grow their profit margins and they're losing money and they don't want to do that anymore, they have to lower supply. They have to stop producing so much. Supply goes down, prices go up. We are at the pivot point. Exactly how long the full pivot is going to take, I don't know, but the economy cannot handle this high level of interest rates for much longer before there is another financial crisis, which I think will come even before we get to the full pivot line of whatever this pivot is. I should stop saying that word. I hate it. Final dollar rally before the end game. Now, this is a controversial statement that I'm making, and I'm aware that it is a little bit fantastic. It might not happen. I'm not saying it's going to happen, but I'm going to show you the evidence of why it might be the last dollar rally before the end game. So here I've put rectangles around all of the places where the dollar index crosses the 50-week moving average since 2005. It is a relatively rare phenomenon because dollar rallies tend to be pretty long events, right? When it crosses the 50-week moving average, it takes at least several months for the rally to run its course. So here's the first one, crossed over here and then went up. I don't know what percentage. It's a nice rally for the dollar here in 2005. Dollar bottom in 2008. Broke back to the 50-week moving average in mid-2008 during the financial crisis. Topped out over here in 2009. Fine. And over here, broke to the 50-week. My point here in all these boxes is to say that every time the dollar pushes through the 50-week moving average, this little blue line, there's a significant rally. Perhaps the only exception is like right here where my arrow is, where it touched the 50-week average, didn't break through. So we could see that. We see here at the end here that we broke through the 50-week moving average just a bit. So we might still reverse back down, but I get the feeling, I get the little feeling that the liquidity crunch is starting, that the desperation for dollars is beginning. And why is that? So why could this be the last? Because if these technicals are correct, and every time, not every single time, but many, many times that the dollar breaks through the 50-week moving average, the rally is significant, it could mean that we are at the beginning of a significant dollar rally. Now, why didn't the last significant dollar rally cause a liquidity crunch? And it was a big rally. I think we got to 117 or something, right below the 2000 high on the dollar index. But there was no liquidity crunch. The regional banking crisis happened after the dollar topped. It happened when that rally was already over. So why didn't the last dollar rally cause a liquidity crunch? Well, because there was a lot of dollars left over in the reserve tank. They had printed so much money in 2020 and 2021 that even though debt service costs were going higher, there's an extra tank of dollars there that banks and other debtors can access in order to pay their debt service costs. But once the dollar tank, reserve tank, is up, then when these companies have to keep servicing their higher debt costs because of higher interest rates and there is no reserve tank, what do you got to do in order to raise dollars to service that debt and stay in business? Well, you have to sell assets. And if all of those banks, all of those debtor banks or whatever the companies are, usually banks first and other debtors later, if you have to sell assets all at the same time to pay your interest costs, then you start a fire sale where all these assets go on sale at the same time and everyone's looking for dollars. That is a liquidity crunch, and that causes a positive feedback loop, or is a positive feedback loop, and then you have the final crisis. So a dollar rally in this environment where we have nothing left in the reserve tank because the dollar supply hasn't climbed since August 2021, which is over 2 years ago now, then yeah, it is possible that this is the final dollar rally before the end game. This is Rafi of the Endgame Investor, enjoying this week's Silver Report for Arcadia Economics. If you also enjoyed listening to it, as I enjoyed giving it, then consider signing up for a 2-week free trial of the Endgame Investor, where I exercise my rhetorical flourishes and have a good time with what is going on in the world of money and finance and interest rates and banks and all the other lovely stuff with the precious metals, etc. Or you can become my patron on Patreon for as little as $3 a month, where I go into the more religious aspects of what is going on in today's insane world.
Yet we know that winter is just another step in the cycle of life. I couldn't imagine a better fate than a long and lustrous winter.